So hi guys, today we're going to talk about gold. You won't believe, but the gold price has shot up 44% in the last 1 year. Well, you must be thinking, why invest in stocks when gold has performed so well? To understand why gold has shot up, we need to understand what determines its price. Well, the price of anything more or less depends upon two things, that are supply and demand. If the supply exceeds demand, the price decreases, and if demand is large compared to the supply, the price increases. Well, this can be observed every year during the Diwali and wedding season. In this time, the number of people buying gold increase and therefore the prices also tend to increase. Apart from this, the price of gold also increases because of inflation. In case you do not know what it is, I would recommend you go check it out. Let's understand the pros and cons of investing in gold and therefore understand whether it is a good or bad investment.
Let's come to the pros and cons. Gold acts as a hedge, meaning it is low risk and relatively stable. It cannot all of a sudden decrease by a lot and is often called as commodity of crisis because it tends to rise in value during times of crisis. It can be turned into cash fairly easily. It helps in diversification, so all your money is not in one place. Let's come to the cons. It is a non-productive asset, meaning the investment produces nothing. For example, when you invest in a company, you're helping it produce the goods and services the people consume. Slow growth in the long run. Capital gains or profits are taxed higher than from the stock market. We do not get any return until we sell it. While if you take businesses or stocks on the other hand, they share their profits in the form of dividends every year. Well, there are four ways to invest in gold. First, buying physical gold, investing in gold mutual funds, investing in gold ETFs, and investing in gold bonds. Let's understand them one by one. When we talk about physical gold, we mean only and only gold coins or gold biscuits, not jewelry. This is because jewelry has many more costs attached to it other than just of gold. However, it can be used to make jewelry for occasions like wedding. We must store physical gold carefully as it can be stolen. Let's come to the next way, gold mutual funds. Gold mutual funds work like normal mutual funds. You give your money to a fund or asset management company, AMC, which in turn invests in gold on behalf of you. The fund charges a fee for having done this for you. This is convenient because you can invest small amounts, even 1000 rupees, through systematic investment plan or SIP, and the transactions are relatively simple. Not only that, just 1 gram of gold costs more than 4500 rupees, which is difficult to keep safe as well. Therefore, it is practical for us to invest small amounts through mutual funds. Well, let's come to gold ETF. ETF is an exchange trade fund or a stock basically, which trades in the stock market. Gold ETF is a stock that tracks the value of gold. What that means is if the value of gold goes up by 2%, the value of this stock as well goes up by 2%, and therefore investing in the gold ETF is identical to investing in gold. Gold mutual funds invest the money you give into gold ETFs. They do not actually buy physical gold. Gold ETF hence has a lesser fee than gold mutual funds. However, you must have a demat account and make these purchases yourself. In general, buying gold ETF directly is more beneficial. Well, let's come to gold bonds. A bond is very similar to a loan. You lend money for a fixed amount of time. This is issued by RBI and backed by the Government of India. Therefore, it is very safe. It was started in 2015. This is an 8-year long bond, meaning you cannot expect your money back in general in less than 8 years. We get 2.5% simple interest every year of what we invested, which made it very popular. In general, gold does not give a fixed return, but this scheme allowed us to get a fixed income even from gold. So if you had invested 1000 rupees, you would be getting 25 rupees every single year for 8 years, no matter what happens to the price of gold. You can invest money in multiples of 1 gram and you get back profits, if any, completely tax free. Let's look at an example to understand this better. Suppose you buy 1 gram of gold for 4600 rupees today. Your interest is being earned every year 2.5% of 4600, which is 115 rupees. Let's assume our 1 gram of gold is worth 5500 rupees at the end of 8 years. Then the total money you get at the end of 8 years will be 5500 plus 8 into 115, which you were getting as interest every single year, which gives you a total of 6420. I'm assuming the value of gold to be 5500 in future after 8 years. I'm not saying it is going to be. Another point that we have to acknowledge is you wouldn't be able to cash in on the profits because of this recent spike. You would have to wait until your 8 years end.
Another common myth or misconception I would like to address regarding gold is that you cannot lose money when you invest in gold. Well, if you had invested in gold in 2013, well, you would have made a loss until 2019. That is not even including inflation. You would be bleeding a lot of money to inflation in the 6 years. If you consider a slightly long horizon of maybe 5 to 10 years also, index funds are often much better than gold. If you haven't checked out the video I made on index funds, make sure to check it out. I'll leave the link in the description below. Let's briefly understand how the gold and stock market react. When the stock market is going very well, the gold remains somewhat constant or decreases a little bit. But when stock market crashes, the gold spikes. This is because people have more faith in the stability of gold. Therefore, they sell the stocks and buy gold. Well, I hope we learned why gold prices shot up so sharply. Well, this is because the lockdown meant all businesses and companies were shut all of a sudden. This caused widespread hysteria and fear, and therefore people stopped buying stocks, sold all their stocks, and put it into gold. And this increased the demand all of a sudden. And we know that increased demand rises the prices of gold. Well, clearly we cannot ignore the advantages of gold, because in times of crisis it can be extremely useful, as you can sell the gold as it is for a higher price and also buy stocks which are already much cheaper than they should be. Therefore, we are suggested to have about 5% of all of our investments in gold. It is important to acknowledge that what happened is exceptional and happens very rarely, and buying gold and anticipating this to happen is not a good idea. Well, if you found this video useful, make sure to smash that like button, subscribe and share it with your friends who will also find it useful.